In this example, we're going to be looking at the journal entries that need to be recorded when a customer actually makes a return to us, the company. So on December 28th, it tells us that Silverman Enterprises sold $18,500 of merchandise to Beasley Company with terms 210 net 30. The cost of the goods sold was $11,200. On December 31st, Silverman prepared its adjusting entries, yearly financials, and closing entries. On January 3rd, Silverman issued Beasley a credit memo for returned merchandise. The returned merchandise originally cost Silverman $2,350 and was billed, meaning that it was invoiced to the customer, for $4,000 with, again, those terms 210 net 30. So they want us to journalize the entries by Silverman Enterprise to record the December 28th sale. They tell us that Beasley actually paid the balance on January 7th. They want us to journalize the entries by Silverman Enterprises to record the merchandise returned on January 3rd, and to journalize the entry to record the receipt of the amount that was due by Beasley Company on January 7th. So we're going to get into journalizing these transactions. So they tell us on December 28th that we made a sale. Again, we're Silverman Enterprises. We made a sale to our customer in the amount of $18,500, and that we had credit terms associated with it of 210 net 30. So that automatically tells us that that sale was done on account. So we have accounts receivable. Again, anytime that there are credit terms, we have to record the receivable and the associated revenue at that net price, which is our sales price of $18,500. And we're going to multiply it by 98% in this case. 100% would be the full $18,500, but we're offering them a 2% discount. So that means that we're recording it at 98% of that original. So we're putting it on at $18,130. And the reason why we're going to be receiving that money sometime in the future is that we have made a sale. We have earned it. So we increase our revenue account by that $18,130. We know that for every journal entry that we have for a sale, we need 2 journal entries. So also on the 28th, we need a cost of goods sold. And our cost of goods sold was $11,200, and our inventory goes down by the $11,200. Please note that that 2% discount only applies to the sales price. It has no effect whatsoever on the cost value. The cost value is what we had originally paid for it. They then wanted us to journalize the entry on January 3rd for the return that the customer had made. And they said that the return is gross value of $4,000. Again, we did offer them a 2% discount. And then that inventory had originally cost us as the company $2,350. So every time there's a return made to us by a customer, we need to have 2 journal entries. The first is going to record what's happening between us as the company and the customer. So we have a customer refunds payable for $3,920. That's that $4,000 gross value minus that 2% discount. And we're going to credit how they had originally paid us. So they have not paid their bill yet, so we're not going to give them cash back. We're just going to reduce how much they owe us sometime in the future. So we're going to credit our accounts receivable. And again, it's the $4,000 gross value times the 98%, because again, it's still within the discount period and we had recorded accounts receivable at net, so we have to reduce the accounts receivable at the net value for that $3,920. We also need on the 3rd to indicate that we are in fact getting inventory back to us. So our inventory account is going to increase, and it's going to go up by the $2,350. And what we're going to reduce is our estimated returns inventory account of that $2,350. And then finally, they said on January 7th, we are collecting payment from this customer. So we are going to get our cash in the amount of $14,210. And we're going to eliminate the accounts receivable balance of the $14,210. Again, for this value, how we're getting it is the $18,130 that was originally recorded, that was what was owed to us, minus the $3,920 that we had recorded as a refund back on January 3rd. The 7th is still within that 10-day discount period, so that's why we don't have to make any other adjustments here. We're just recording the cash that's being received and eliminating that outstanding accounts receivable.